Welcome back. Today we're digging into Global Medical REIT's second quarter earnings for 2025. Now this was a really pivotal quarter, not just because of the numbers, but because it's the official start of the era for their new CEO, Mark Decker Jr.
So let's get right to it. The headline numbers, they look pretty solid. I mean, they met expectations, even beat on revenue, and yet the stock traded down about 2, maybe 3% after the call. So what's the deal? What did the market see that wasn't obvious in the press release? That's really the core question we're going to unpack today. All right, first things first, let's just run through the headline numbers. We got to see what the company actually reported and how it stacked up against what everyone was expecting.
Okay, so funds from operations, or FFO, that's the key earnings metric you always look for with REITs. GMRE came in at 20 cents per share, which was exactly, and I mean exactly, in line with the Wall Street consensus. So right off the bat, no surprises here. Just looks like solid, steady execution.
But here's where things get a little more interesting. Revenue. They posted $37.9 million for the quarter, and that beat the consensus estimate by over $2 million. That's also a really healthy 10.7% jump from last year, which shows some real momentum on the top line. And here's the big one. Management reset the quarterly dividend down to 15 cents from 21 cents. Now look, a cut is never what you want to see as an investor, right? But management did a good job framing this as a right sizing. The goal is to improve their payout ratio and, get this, hang on to about $17 million a year that they can now reinvest back into the business. It's a pretty crucial strategic move. So if FFO was just in line and revenue actually beat, what were the underlying forces pushing and pulling here? Let's take a look under the hood at the key operational drivers that really shaped the quarter. And this slide really lays out that balancing act perfectly. On the plus side, the tailwinds, they had a major new lease with CHRISTUS Health that started paying rent. And they bought a new portfolio for almost $70 million at a super attractive 9% cap rate. I mean, that's a fantastic initial return on investment. But that was offset by some headwinds. Occupancy dipped just a bit to 94.5%, and that was partly because of the ongoing bankruptcy saga with Prospect Medical. This quarter wasn't just about the numbers, it was really about the narrative. And there's a whole new narrative being written by the new CEO, Mark Decker Jr. This is his story now. And Decker is no rookie in this game. He was previously the CEO of Centerpace, which is another smaller public real estate company, and he led them through a pretty significant repositioning. So he brings direct, super relevant experience in how to transform a business of this exact scale. So when the analyst asked him point blank about his game plan, Decker laid out 3 crystal clear immediate priorities. Step 1, finalize the new strategic plan with his team and the board. Step 2, get in there and tackle the big credit facility refinancing that's coming up. And step 3, execute on capital recycling. That's just a fancy way of saying sell some assets to fund new, higher return investments. Simple as that. I thought Decker's whole philosophy was summed up perfectly with this quote. He said the company has a bunch of good ingredients and that we can organize those a little bit more thoughtfully. What that signals to me and to the market is that his focus is on optimization and disciplined execution, not some radical, tear-it-all-down kind of overhaul. All right, let's shift over to the Q&A session. This is where you really get a feel for what's on investors' minds and, more importantly, where management is putting its focus for the future. The analyst questions really boiled down to 5 key themes. They hammered him on leverage, and Decker gave a target: get debt under 6 times EBITDA. They wanted a number for asset sales, and he gave them one, 50 to 100 million. They got some reassurance on occupancy, with a goal to climb back above 95% by the end of the year. Management also got ahead of the story on 2026, saying new cash flow should help offset what will likely be higher refinancing costs. And finally, they confirmed that, they're still finding great acquisition deals out there north of a 7% cap rate. So, you put all that together, what should we be looking for in the next quarter? What really matters? Here's our take. All right, let's wrap this all up with our equity research style rating. Based on a solid quarter, but with a lot of change on the horizon, what's our call on the stock right now? We're rating GMRE a market perform. Here's why. The operations are steady, and they reaffirmed their guidance, which is always a positive. But the market is clearly in a wait-and-see mode. This is a show-me story now. The stock's future hinges entirely on how well Decker executes his new plan, especially that massive credit facility refinancing. Until there's more clarity there, the stock's probably just going to trade in line with its peers. And looking ahead to Q3, here's our specific prediction.
We expect AFFO per share to stay right in line with their full-year guidance. No surprises there. We think the stock will stay pretty range-bound, probably bouncing between 10 and 12 bucks. And the single most important catalyst to watch for, it's not a new building or a new lease, it's going to be concrete progress on refinancing that credit facility. That is the key that unlocks the next chapter for this company.
And finally, let's have a little fun with our last segment, the trade idea. This is where we take the analysis a step further and cook up a potential trade, maybe a little out there, but totally plausible, based on everything we've just talked about.
Okay, we're calling this one the disciplined recycling pairs trade. The thesis is pretty straightforward. If Mark Decker's team can actually pull off selling those lower-yielding assets and plow that cash back into the 8 or 9% cap rate deals they're finding, they can generate way better FFO growth per share. And the law of small numbers is on their side. A small deal for a big company is a huge deal for a company GMRE's size. So the trade is simple. You go long GMRE and you short a broad lower-yield REIT ETF like the XLRE. It's a bet that GMRE's specific execution will let it outperform the wider, interest-rate-sensitive market.
And that's our breakdown of global medical REITs quarter. Thanks for tuning in. And just a quick reminder, this content is for informational purposes only. It is not financial advice.